Harshvardhan. I'll be moderator for this wonderful panel discussion. We have our panelists. We expect Ajit Ranade to join soon, but let me quickly introduce and get started. Oh, Ajit, you're there. Wonderful, wonderful. Good evening, Ajit. Yeah, okay. So we have four panelists. I'll introduce them in the alphabetical order. We have Dr. Jahangir Aziz, he just told me he's in New York, snowed in New York. He is the head of emerging market economics for JP Morgan. Then we have from the exciting and excitable city of Washington, D.C., Josh Feldman. Josh spent many years with IMF, including as head of its India office, and then also did a stint in Ministry of Finance. So has a very good sense of what happens in India. Then we have Dr. Rajiv Lal, who was the founder, CEO of IDFC Bank, which now we know as IDFC First Bank. And prior to that, he will spend time with the World Bank, with a private equity firm. So he has a very diverse financial sector experience. And then we have Dr. Ajit Ranade, who is the president and chief economist of the Aditya Birla Group, which is a large conglomerate in India. So we have a very diverse panel. And I look forward to having a very, very good discussion. Just a couple of housekeeping rules. Please put your devices on mute so that we don't get any disturbance. And I hope that we have some time for Q&A at the end, but through the conversation, the chat, I will be monitoring the chat box. So if anybody has any comment and question, please write that down, and I'll try to weave it in the conversation if I can. So let me give a 2-minute context. Recently, the RBI's internal working group put out a document regarding new norms or at least suggestions on ownership norms, including suggesting that the private corporate groups may be permitted to get bank license, and that has created a lot of debate. But that is not where I want to begin. I want to begin this conversation at a different place, and that is this. Last couple of fortnights, the credit growth in the banking system has been around 5.5%, which is probably several decade low. And you have to keep in mind that this growth rate of credit is so low despite all the recent effort on credit guarantee, on capitalizing of moratorium, interest, and so on. So actual credit growth may be even lower at around 3%. And this is not just a COVID impact. This, if you go back, we have been a secular declining credit growth situation from 2011, when it was 30%, and it has been basically steadily coming down. We had a little bit of a blip in 2019, but then it has continued to go down. So with that context, and banking credit growth, I believe, is very, very important for Indian economy. If you take a 60-year average data, you find that the ratio of banking credit growth to nominal GDP growth is about 1.4, which means if the nominal GDP grows at 10%, the banking credit typically grows at 14%. So this very low credit growth shows that probably the underlying GDP growth is really, really poor and is declining, which anyway, what we know. So with that, let me start with you, Rajiv. You were a banker, so you have a first-hand experience of this. What would you ascribe this anemic credit growth to? And do you think we are likely to get out of it anytime soon? Hello?
Yeah, I'm just unmuting myself. Yeah, I've just unmuted myself. Yeah. Well, so it's I guess the straightforward answer, as far as I can tell, is there is a supply side problem and there's a demand side problem. The supply side problem is reasonably well understood. There's on the whole, there is impaired capital in the banks. There is insufficient capital. If you take the public sector banks as well, the damage that has been done to balance sheets over the last decade and a half really hasn't been repaired quite as yet. And in the public sector banks, obviously, you have a shareholder that can't really afford to recapitalize very aggressively because of fiscal constraints. So that's, in a nutshell, the supply side problem. There is another aspect to the supply side problem, and that is, I think, what has happened to risk appetite post the boom years of 2005, 2012, right? So I think that once bitten, thrice shy. And it's not limited just to public sector banks. It is also infected the private sector banks. that people have become extremely wary within banks in risk management groups of the corporate sector in India. So everybody just wants to lend to a handful of corporates, none of which need the money. The rest of the corporate sector is just dismissed for a variety of reasons that are relatively well known. On the demand side, I think the problem is to do with how the demand for credit is actualized, so that it can be met by willing lenders, and that has to do. Sorry. Hello.
Hello. Yeah. Go ahead.
And that has to do with the lack of traditional collateral mechanisms that make credit accessible from traditional bankers to the vast segment of the economy that is crying out for credit. So the small enterprises, the micro enterprises, all of India really is self-employed. This lot is starved of credit on a relative basis, because traditional bankers are just not comfortable, do not have the data or the underwriting skills and confidence to deal with that demand. So that's my my take on the problem, and it's a big, deep structural problem. This will require huge amounts of change to a number of things to get the credit rate growth rate going again.
So we'll come back to that, but let me get Dr. Jahangir here. Can you hear me? So I mean, is this something you see unique to India, or particularly worse in India compared to other emerging markets? You have a very good view of other emerging markets, but also specific understanding of India.
So no, I mean, I think that this is generally the case in almost every country that we are looking at, particularly in the emerging market side. But even in developed market, that's more or less the case. I mean, the only exception that we'd seen prior to the pandemic was in Brazil, where we did see bank credit pick up. But again, it was coming from a very low base, and even lower base than in India. But beyond that, I think bank credit has been very subdued for a very long period of time. And I think this has to do with the fact that, what Rajiv said, I mean, there is a supply side issue and a demand side issue. And while India has the problem of, having, problems with its capital, capitalizing, public, PSU banks, in other countries, it is the second point that Rajiv raised, which is risk appetite. I think risk appetite across the board, both in, post the global financial crisis, post Dodd-Frank, post BIS's new lending norms, and that, bank credit itself has been, the risk appetite has been brought down. Again, some of it is regulatory. The other is essentially that, there are serious concerns about future growth going forward. And I don't think we've ever come out of that since the global financial crisis. And I think that the key to, in the case of emerging markets, I think the key driver of that, and again, whether it is something that is the reason, I mean, whether it's independently driven or has been driven by the growth factors, is the fact that, at the end of the day, if you go back and look at emerging markets for the last 20, 25 years, there is essentially has been a single growth driver for emerging markets. That growth driver is changing, but even now, the dominant growth driver has been, globalization or trade or export growth, whatever you want to call it, right? And from 2020, 2012 onwards, there's been a collapse in trade growth. And all you have to do is to draw, the growth rate of, trade and superimpose on that growth rate of emerging markets. Whether you include China, you don't include China, it doesn't really matter. There is no daylight between the two lines. If you look at the, the domestic part, quote unquote, the domestic part of emerging market growth, consumption and investment, you take investment, You draw investment as a share of GDP, for example. In the case of India, I mean, India supposedly this closed economy, and you draw export as a share of India, even on a quarterly frequency, there is no daylight between the two of them. So I think there is a global decline in the engines of growth that drives emerging market. We have not really managed to find alternative engines of growth. That engine of growth, which is global trade, again, that's a conversation about what has been the drivers of global trade and why it has come down. But essentially, potential growth has come down, trend growth has come down, and with that, trend banking credit has come down, bank credit has come down. So, in some countries, you do see, as you pointed out, whether they have diverged away from the traditional relationship that they've had with nominal GDP growth. In some cases they have, in some cases they haven't. But broadly, I don't think that is just an India problem. India problem is far worse than other emerging market countries because of its supply side issues, but it's broadly across the board in terms of emerging markets that we see this phenomenon going through. Yeah.
Sure. Ajit, you bring in the borrower side. You represent a conglomerate, a very well regarded one. So from your perspective, when you look at companies, the borrowers, the demand side, what do you see?
You mean in terms of demand for credit, right?
Yes.
So if I take obviously I'm not here just to represent my group because I'm not the spokesperson.
I understand that. What I meant is the demand side. Yeah. As somebody who sits on the demand side, let's say.
Yeah. So, this Jahangir's thesis that collapse of trade, if I can call it collapse, is correlated to collapse in demand for credit. I'm not sure I fully subscribe to that. The bigger, at least the India-specific explanation, I think, is that there was over-leveraging. There is a theory that between the earlier decade, that's 2003 onwards, there was excessive leveraging. And so the phase where we see decline or slower growth in credit is the phase of deleveraging. So that's, I think, one big determinant of the explaining the somewhat slower growth in credit. And there's, of course, risk. The second explanation is a supply side explanation, which is the risk appetite. That on a risk-adjusted basis, the hurdle rates, or the collateral and the comfort factors that bankers want is higher. And the usual culprits, the usual suspects or the usual victims continue to be denied credit, which is MSMEs and small borrowers. All said and done, India's credit to GDP ratio still lags, I'm sure, in most emerging markets, at least in Asia. So it's not as if it is credit has blown. But I believe what you're seeing in this decade is a combination of deleveraging process, lower risk appetite both sides, from the supply side of the bankers and from demand side also, because of over leverage earlier. Deleveraging means that newer large projects from the private sector were not forthcoming. In fact, it's manifested in the investment to GDP ratio, which has stagnated at around 28% for the last 4 or 5 years. Also, in addition to that, not a demand side, but a supply side factor is this regulation or policy which says that large conglomerate exposure of banks
is limited at 25.
Yeah, the group exposure norms.
Limits.
I think that
single borrower limits. Yeah.
Single borrower limit or group limits also. That group also limits has had some contribution towards constraining borrowing.
So, Josh, you were in the ministry around the time when both the peak credit growth happened and then subsequently AQR and the decline in credit started. The decline in credit growth started. What would be your view? What could be some of the action steps that could be taken at the policy level, at the regulatory level, if we had to address this credit growth problem? Just a bit of factoid responding to Dr. Ranade. Our private sector credit to GDP ratio shot up from something like 30% in 2000 to about 50% in 2010-11, and it has basically stagnated there. It's probably right now about 47, 48%. So for 10 years, our bank credit to private sector to GDP ratio has not grown, which is actually, and we are way below even other emerging markets. I mean, I think only Indonesia is below us, but Thailand, all of them are actually above us. That's just a fact. So Josh, over to you.
Yeah, well, obviously, I mean, to summarize what everyone else said, the essence of the problem is the twin balance sheet problem, right? So you need to attack both sides. And the strategy at the ministry was very, very clear. On the banking side, recapitalize the state banks, and on the corporate side, introduce the IBC in order to clean up the corporate sector. Now, of course, both of these initiatives ran into problems. The state banks haven't been adequately capitalized, and it took a long time even to get where we are today. And even now, the problem of cleaning up the books and recapitalizing them is still not done. And on the IBC side, it turned out that the IBC was much slower in dealing with the corporate problem than we'd hoped. And then, of course, everything got messed up by the COVID. There's a third problem that really hasn't been addressed and wasn't mentioned by the previous commentators, panelists, which is that clearly, much of the investment that took place a decade ago was in the infrastructure sector, and it turned out that the framework for that investment wasn't really up to the task. Firms quickly discovered problems with the framework, and there was no real mechanism to sort these problems out. And in the end, many of the firms wound up in bankruptcy. Some of them, for example, in the power sector, are still just hanging on, and nothing really has been done to sort out their problems. The power sector problem really needs to be sorted out, just to clean up what was done in the past. And if we ever want investment in infrastructure in the future, and of course we do, and we need it, that framework is going to have to be repaired and a viable framework found. I'm sure Rajiv can talk for hours on the subject.
Yeah. So in addition to this anemic credit growth, we have had a lot of scandals in the banking system in the last 2 years, starting with the ILFAs in the Yes Bank, and then DHFL, and then that Punjab National Bank. And all of them have raised questions about our regulatory capacity, our supervisory capacity of the financial sector. Dr. Aziz, let me start with you. Do you see both a gap in our regulatory and supervisory capacity, and more importantly, is that impacting our macroeconomic stability?
Yeah, so certainly there.
Sorry.
Hello?
Sorry, Rajiv, I'll come to you. I'll start with Jahangir.
Okay.
Sorry, Jahangir, could you hear me?
Sorry. Yeah. So I think that, I mean, on a global basis, India stands out. India stands out of having, serious problems regarding bank supervisions. I can't see any other large emerging market countries that have similar size problems. So, in listening to Ajit's argument, I wasn't saying that India's problem is not different from other emerging market countries, but there's strong common elements. In terms of India per se, look, it is obvious that, if on a day-to-day regular supervisory capacity clearly was not enough, because the RBI was forced to do a separate AQR to resolve, just to look at the asset side of the banks that they themselves supervise. I mean, you don't do that if on a day-to-day basis, you have reasonably strong supervisory capacity that you don't need an AQR. The fact that you did an AQR basically suggests that your day-to-day supervisory capabilities isn't strong enough to deal with these kinds of issues. And again, it isn't something that should be surprising, given the fact that just in terms of manpower, I mean, how many new people? I mean, we have seen far more complicated instruments and far more complicated lending practices within the banking system over the last 20 years. I know that you will say that debt to credit to GDP ratio has stagnated just at around 47%, but it did rise from 30% to 47%. You have more, much more deeper issues regarding which sector regulations being changed, changes in group regulations, etc. My simple question is, what was the increase in the number of people that in the division that in the supervisory division in RBI? Just that. I'm not even talking about the quality of it. I'm not talking about IT expansion of IT, etc. Just the number of people that RBI actually put in place in order to address. And I think that is, if you compare them to any other, any other, even the larger emerging market countries, South Africa or Brazil, they have a much larger supervisory number of people doing bank supervision than RBI does. So, I don't think that's much to debate about, that there is clearly a serious problem with the regulatory side, in the sense that the capacity is constrained. And that is, part of state capacity more generally being strained. And I think RBI just falls into that category. RBI really needs to increase massively its supervisory capabilities. Even if it does not want to bring in corporates into the banking sector, even then it really needs to expand. Seriously expand the same. Yeah. So
let me get Rajiv in. He wanted to make a point. Rajiv, up to you. Hello, Rajiv, are you there?
Yeah, unmuting again. So I've been, for the last year or so, I've been one of the advisors to the DHFL resolution. And
good luck.
Just watching that has been quite an experience. Now, it was an NBFC, so it is less intrusively regulated. But clearly the types of things that were going on under the nose of the regulator.
Which was the NHB, by the way, that time.
Yes, so that's what I meant. And even now, actually, I don't have the ability to go into any of the detail, but the lack of clarity about the relative responsibilities of the NHB and the RBI, simple thing, is pretty shocking. Even today, the line seems blurred. So I'm just building on Jahangir's point about the lack of supervisory capacity, and to place it in much broader context. It turns out that India, in terms of government employees per capita, is really has one of the smallest footprints of any emerging market by far. And it's been shrinking. It's been shrinking at a very rapid pace over the last 20 years. So as much as we like to, so it's almost as if we are, in the public discourse, people
the state
generally
is shrinking.
People generally throw these terms in a very loose fashion. We are fighting a battle of 20 years ago, too big a state, regulatory impediments, this and the other.
Exactly.
The fact is that we have a very, very poorly capacitized state to do basic functions, of which banking supervision is just one.
Yeah. So let me get Ajit on a point that I made. So we have poor capacity, we have impaired banks, and yet in the entire COVID revival, our entire emphasis has been on monetary policy and banking system. In fact, the 20 lakh crore package that the government announced, I estimated that roughly 70% of it actually is to be channelized through the banking system, whether it's to partial guarantee and credit and this and that. How do you square up these two things? We have cut our rates to probably the historically lowest rate, and still credit growth is so anemic. So are we using the right levers to revive the economy?
By the way, to add to Rajiv's point, and I think Jahangir also referred, the one number which signifies the capacity constraint is that the number of employees of RBI has gone down to half, 50% from about 10, 15 years ago. I think they used to have 30,000 employees. Now they have 15,000 employees. So that actually, that one number captures what's the problem. Harsh, I think I heard somebody say, so regulatory capacity and regulatory framework.
Yeah.
So I mean, we need to address them two separately. Capacity is the head count I just mentioned, but I don't know. We agreed that the framework is right. So I mean, the hope is that at least the framework is right. So we just need more capacity to implement the framework. But going to your question, of course, it is because of fiscal, and this is my fellow panelist's favorite topic. I'm sure Jahangir, that fiscally there is very little room, and therefore it's a tag team, fiscal and monetary policy. The Atmanirbhar package is called 20 lakh crores. They call it a package because they don't distinguish between the two players. But much of it, I think more than 80%, is taken up by monetary stimulus or in the form of whether it's cutting rates or liquidity support, loan guarantees, and whatnot. Now, I don't know whether to call it a liquidity trap because you have plenty of liquidity. The rates are at an all-time low. In fact, the gap between the policy rate in India and the policy rate of the US is actually almost at a, 15-year low or something. It's really
actually longer. It's more like a 40-year low.
Yeah, exactly. It's a record low. And yet, and by the way, during 2020, that is, we're just ending this year, the debt, meaning the foreigners who put money into debt market in India, that is basically government bonds to
gone out. It's all gone out. Debt money
minus 20 billion. So 20 billion has left. Yeah. Despite all the huge stories of equity inflows, FDI, private equity, the fact is that $20 billion have left the country debt on debt side. So so these low rates are not helping. So I think it's a problem of liquidity trap that if you are near bankruptcy, if your livelihood is at stake, then a small borrower or whatever, medium-sized borrower is not going to take on additional loans, despite the loan guarantee, by the way. In fact, there are 3 lakh crores were allocated to this MSME
only
guaranteed
60%
loan.
has been taken.
It was announced in May, and after 6 months, just about barely 60% has been
60%.
sanctioned.
Yeah, correct.
So I think it's a problem of essentially you need more fiscal tools than monetary, but fiscally we don't have one room. Well, I just want to plug in my favorite point because I can't miss this opportunity, so much audience. I think the RBI and the government of India should do a bilateral deal, which is loan against shares. So it's pledged. It's not monetization, it's disguised. And they do it at a reverse repo transaction at a repo rate of maybe 4 or 3.5% for 5 years. The shares go back to the government of the PSU shares, by the way, are worth 15 lakh crores today. So do the share swap, loan against shares, and that itself might actually contribute.
Yeah, but that then government loses the ability to extract dividends and buybacks and so on. So there is government uses the shares for other purposes, fiscal purposes as well, right? The moment
but this is like, this is at least using leveraging your asset rather than a pure monetization of the deficit.
So this is backdoor monetization, effectively.
Backdoor, but two backdoors actually. It's twice.
Okay, Josh, I want you to wear your macroeconomist hat and comment on this. So we seem to have impaired banking, poor regulatory framework and capacity. We have no fiscal room, and we have a pandemic and a crisis and potentially 7-8% contraction in GDP. How do we get out of this?
I actually want to answer a completely different question because I want to take issue with Jahangir, Rajiv, and to a certain extent Ajit about the regulatory problem at the RBI. I really don't think this has anything to do with the number of people at the RBI. Ajit mentioned is the problem regulatory capacity or regulatory framework, and clearly the problem is with the framework or the implementation of the framework. I want to quickly review what happened at PNB. What happened at PNB was there was a report by Deputy Governor Mundra, which said that there was a problem in the banking system, that the SWIFT system was not integrated with the core banking system, and several circulars were sent by the RBI to the various banks, urging them to integrate these forthwith and to verify SWIFT transactions going back to 2015. This was not done at PNB. In 2018, instead, they notified the RBI that for the past 7 years, they've been scammed by 14,000 crore. And this occurred at a time when there was there was a person at the RBI who a senior supervisory manager at the RBI whose task it was to make sure that PNB was implementing all the circulars. And there was also someone on the board of PNB whose task was the exact same thing. Now, we never found out the resolution of this, so we never. So there wasn't any follow-up of the regulations at the time, and since then there's been no follow-up to change the system to make sure that this can't happen again. This is the fundamental problem. It's not a question of lack of people. It's a question of lack of follow-up of the implementation of the regulations that exist. And unless this problem is corrected, we're going to have the problem again and again. And I'm sure we're going to get onto this, but the problem is going to be tenfold worse if industrial houses are allowed to own banks. So I think we need to understand the problem before we race ahead and prescribe solutions. And certainly just doubling the number of people is not going to help.
Yeah, but Josh, you can't really solve the problem or understand the problem if you don't have the capacity to understand the problem. I don't see this idea that the framework and the capacity are two different issues. It's the same issue. I don't mean number of warm bodies as capacity. What I meant was the actually getting people with domain knowledge. And that is what we don't have. So I don't see how we can have a framework if we don't have the people who are doing it have the domain knowledge.
Yeah. Well, earlier people were just mentioning numbers. Exactly. I mean, there's several issues here. Capacity in the broader sense of domain knowledge, and then sheer following up on regulations to make sure that the regulations are actually adhered to. You need both, right?
So, Josh,
and the RBI needs.
Josh, just as somebody that's been intensely regulated by the RBI, I have to say that whenever the bank that I was involved with had interface with the supervisory staff of the RBI, they were actually very, very thorough and very meticulous. I have actually generally been, on the whole, quite impressed with the quality of the younger, lower-level staff of RBI that I have encountered over the years of being supervised. I have found them to be under tremendous stress and pressure of work. They were just stretched to the bone, very, very, and people don't give them enough credit for how hard actually they have to work. And in that sense, even the numbers do matter, is my sense of it.
Okay. So Rajiv, let me, across the world, we have seen technology disrupting financial system, banking especially. In India, we have not seen fintechs do much to banks yet. There's a lot of hype, there's a lot of talk, but not much has happened. One of the reasons probably for that is also regulation. So for example, our regulators haven't yet opened up a banking system for non-bank participants. Payment system is a good example. So I find it a little bit anomalous that on the one hand, you guard, let's say, payment systems. On the other hand, is a talk of allowing new private banking licenses. Note that we already have 150 scheduled commercial banks. Do you believe adding new banks is going to solve any of the problems that we have talked so far?
To be honest, I'm not quite sure. I'm not sure that it will.
And independent of whether it's corporate or not, that's a separate issue, who the owners are. But
correct.
Just issuing of new licenses in a setup where there are 150 scheduled commercial banks, among the most fragmented banking sector in the world.
Yeah, I'm not sure that adding to the number of players is necessarily going to help. As I say that, the other reality that we need to confront, that this debate or the challenge of governance in banks is clearly not limited to just public sector banks. I've come increasingly to the point of view that governance challenges are not ownership determined necessarily. So I hesitate to take an ideological position on private banks versus public sector banks. So it has a lot to do with the basic problem of risk appetite, which in turn has to do with, I guess, a cultural context in which the banking system has gotten used to certain styles or ways of underwriting. Now, so you have to think carefully about how to change that culture. And there, the data revolution is a very powerful tool. How is that availability of data introduced into the banking system to motivate bankers to change how they underwrite? I think that is the revolution that needs to be catalyzed in the country. I don't have a clear answer of how to get it done, but what I do know is that there is a lot of data, and it's growing by leaps and bounds. There are some banks, not all, some banks and some NBFCs that are capitalizing on that trend. That trend needs to pick up pace. There are some things regulatory that can be done to accelerate that pace, but there are
example.
other
Can
factors.
you give maybe one example of a regulatory change which
So
will allow
this whole thing about the GST database. If the cash flow data from GST could somehow be made available to banks, right? If you could solve that problem, that's a very, very powerful tool. I entirely agree with Nandan's vision on this, Nandan Nilekani's vision on this. There's a very powerful tool to make credit available to micro, smaller enterprises, which is really the bulk of employment generating India.
Okay. Ajit, let me come to you with this question. Do you believe adding new banks by issuance of new licenses will address any of the problems that we're facing broadly? I mean, in banking, but also broadly in the financial sector.
Yeah, well, what is the optimum number of banks for India? I don't know the answer to that. I don't know how to research that question. Is there a way to consolidate or a very active market for M&A and consolidation, including hostile takeovers? I don't know. So in that context, I think we need to introduce new players, right? Or if the other option is to somehow have the aggressive privatization done for the public sector banks. And I don't know if you'll have time to go into the ownership debate, but the fact is that I think the one fact I think all of us can agree is that Indian banking needs huge amount of capital, right?
Yes.
And where is that capital going to come from? That's the question.
Well,
and the
counter to that, Ajit, if I may, the counter to that is that the top 3 or 4 private banks have proved that it doesn't have to come from one group, but it can come from market. If it's a well-run bank, it can come from public markets.
No. Wait. I'm talking about the seed capital, the risk capital. Of course, when a bank is doing well, HDFC Bank is the most expensive bank in the world. So once you have a 5 to 10 year track record, people will hungrily lap up the shares of. So you need to have a diffusion for what is called dilution roadmap from date 0 to date 5 years or date 10 years. I'm talking about that part, that portion. Of course, you're right. Once it's a well-run bank, IndusInd Bank, or is a Chota HDFC Bank, of course, people will lap it up. That capital is available, by the way. I'm talking about the seed capital to infuse, from scratch. And that can come only from a foreign bank. But if you are willing to let foreign banks into India and give them unlimited branching, possibilities, or that capital currently, whether you like it or not, sits in the corporate sector, large corporates. That's where risk capital is residing. So you force them and make them dilute to the bone in 10 years or 5 years, 7 years, but they need to get a good bank going. And, I can talk about many other things, but basically this is risk capital. And,
Okay.
we are not in 1969. I don't have to say that. So we have, and since Rajiv talked about data, we have so many other, thousands of eyes looking at, use AI tools. So you supplement your whatever is lacking in regulation and governance with more modern tools. And then, of course, we can talk about it, all that stuff. But basically, I think the central problem is how to get more risk capital to kickstart, and get the first 10-year journey, after which the banking capital markets will be very happy to fund balance sheets, bank balance sheets.
Okay, thank you. So to all the participant, all the audience, please, if you have questions, raise your hands. I'll ask my last question, and then we'll move to audience question answer. So please raise your hands on the Zoom. So recently in one of the conversation, I used this phrase of the Narsimhan moment. Is our banking at a Narsimhan moment? Some of you would recall in the mid-90s, we have two committees chaired by Mr. Narsimhan, which actually brought in humongous changes in the banking system on the back of a severe crisis that we had faced post-liberalization and the Harshad Mehta scandal and so on and so forth. Mr. Narsimhan is 93-year-old. We wish him long life and good health. So he may not be it. But my point is, are we at a moment where we have to take a comprehensive look at banking and bringing a whole slate of new generation reforms? So Jahangir, let me start with you. And if yes, what could some of those reforms be?
I think that, I'm not exactly sure whether India is overbanked, but definitely India is overcommitted. So I think the Narasimhan committee of 1 and 2, and we've had several financial sector, very large, very comprehensive financial sector committee reports since then. I really do not think we need to have one more committee to look into a comprehensive view about the banking sector. We know the problems, we know the solutions. I don't really see that there is any real change will be brought or new things will be brought about by the committee. It will be what things that Ajit, for example, said.
Or several other committees have said in the past.
Exactly. There has to be a way in which you remove this asymmetry of distribution of deposits, the asymmetry in the distribution, asymmetry in the distribution of lending, and that has to do with a proper privatization, and not privatization where one public sector buys another public sector, actual privatization. Now so that of course leads to the question, which is Ajit's question, and it's a valid question. Where does the risk capital come from? Now, from my point of view, having seen and read, over the last 30 years of my career, emerging market banking crisis, I would rather that the government borrowed another 10% of GDP and used that as seed money than allow corporates to own banks. That's basically the bottom line. That the history of emerging market crisis is replete with this particular issue, that this is not about theory, this is not about ideological basis, whether you're a neoliberal economist or not. This is the fact, including in Korea, which is the model I'm guessing we are trying to emulate, the chaebol model. It had a spectacular success for about 30 years and then a spectacular collapse. And I don't think India needs to go.
But Jahangir, if I may point out, even the Korean chaebol, most of them don't own a bank. Samsung has every conceivable business in.
No, they used to. No.
Samsung has everything from golf course to shipbuilding, but doesn't own a bank.
That's correct. But that's the post-97 crisis reforms that came with the part of the IMF program. Look at pre-97, right? This is the model we are trying to emulate, where, it's a few good men theory. If you get a few good corporates and give them all the resources in the world and have very close relationship with government, then you can deliver China-like growth or Korea-like growth, even with electoral democracy. It doesn't work that way. And we know how badly that story turns out to be the case. So in answer to Ajit's question, I would rather that the government went and borrowed 10% of GDP, whether it's in foreign markets or in domestic markets, recapitalized its banks, did privatization in the secondary market, rather than allow corporates to own banks.
But when I asked you the Narasimhan moment question, it was not another committee, but really, if you were to pick, let's say, 2 or 3 reforms or changes, I won't even call reform, what would be they, and what do you see as the big impediments to them happening?
So I think the first thing that has to be done, at least in the banking sector, is not to get the regulator, which is the RBI, to come up with development strategies. When you hand over the ability of the task of reforms to the regulator will do what it does best, put in more regulations. This has to be done by a body outside of the regulator, which happens to be North Block. It has to be the Capital Markets Division. It has to be the Financial Services Division that needs to do this development. So I think the first step is that whatever changes we bring, please let's not go back and ask the RBI, the regulator, please give us those changes, because it is not going to happen. The second thing is, in terms of very concrete steps, it is reasonably straightforward. Whether you take the money from RBI, which I agree with Ajit that, whether Ajit's program, Ajit's solution is way too complicated. Just go and take the capital that the RBI has. There is no reason for RBI to have that kind of capital. Take that capital, recapitalize the banks, and have a clean privatization program. That's it. You don't need to go and reinvent the wheel. Just have a clean privatization program. Recapitalize the banks. RBI's profits are not really RBI's profits, right? The people of India and the government of India in turn has paid for those profits. This is the time to need it, use it, recapitalize the banks, and then say, I'm going to have a hands-off privatization program in the secondary market. I think that alone is going to resolve half the problems. And then, of course, you need to make the rules, and you need to make the changes in the rules and regulations, increasing capacity of the supervisory while liberalizing the banking sector. Those are all changes that can be brought about. And again, there are lots of people in this, people who are listening in, Ajay, for example, who pronounce backwards what specific steps needs to be taken. I'm not the person you should ask for, but to me, fundamentally, if the problem is a lack of capital, RBI has the capital. Take it from them.
Josh,
but you have to have a privatized program.
Josh, you've seen India from within and now also from a distance. What, in your opinion, there have been numerous committees. We have made recommendations, all good ones. We have all that intellectual capital available. What comes in the way of doing some of those things and fixing the system? Josh?
Yeah, let me answer. Let me kind of answer the previous question first. Right in India, there are 100 scheduled commercial banks, SCBs.
150, Raj, 150.
Well, I'm excluding the cooperative banks. Forget them.
Okay.
Right. So when you exclude them, you have 100. Right.
Yes.
So the question really is, why aren't these banks growing? Right. I go back to what you said at the beginning. If you look, there's just been a 10-year slide in credit growth rates. That's the real issue. Forget, it's not a question of we need more banks. It's not a question of seed capital. It's a question of why aren't these banks growing? Now we know the answer is not because they can't get capital. Ajit pointed out that actually it's quite easy to get capital, and I'll give you 2 examples here. Over the past 5 years, private sector banks have raised 1.15 lakh crore new capital, right? Even now, as we speak, PNB, which made a whopping 600 crore profit last quarter, is raising 10,000 crore in new equity and loans and debt. So, as Ajit was saying, for the existing banks to raise capital and grow, it's really quite possible. So why aren't they growing? it goes back. So the real issue that we need to address is the one that we discussed at the outset of the panel, right? This problem of risk aversion and the underlying reasons why the risk aversion exists. And as I mentioned earlier, if you want the banking sector to grow, what you need to do is you need three things. You need to solve the you need to recapitalize the public sector banks, and there, as I mentioned, as Jahangir mentioned, capital can be taken from the RBI to do this. You need to use the IBC to solve the problem in the corporate sector. That's still a job in progress, particularly for the power sector. And you need to have a new framework for infrastructure. You have to solve the fundamental problems and not get distracted. You have to realize what the real problem is and focus on that. And as to the question of why this isn't done, to a certain extent, it's a problem of diagnosis. There's a constant belief that oh, if we just do this, if we just let industrial houses own banks, then the whole banking problem can be solved. If we just hire 15,000 more people at the RBI, then the supervisory problem is solved. And the point that I'm trying to make is, no, these diagnoses are wrong. They're simplistic. You have to tackle the real problems. And only when you do that will you get real results.
Ajit, let me come to you and combine what Jahangir said earlier, what Josh said, and what you said. So let us assume that we did either through your solution of pledge of government shares or taking capital from RBI or even direct monetization and use that money to capitalize bank. I mean, one could argue, what's the guarantee that that money, that capital again will not be eroded to another wave of bad loans if you don't fix the governance issues in public sector bank? What would your answer to that be?
So there is already the PGNI committee, the framework available, or have. I think that's surely not so difficult to implement. I don't know. You have this holding structure. The government owns a holding company. So you actually you raise capital at the holding company. You privatize that, and you keep that 50% shares in individual bank, but you raise capital in the holding company, and then you, of course, the governance is board driven. That is a step not too far, I think. So if you ask me, that's one step. But incidentally, about large corporates, I'm not here to bat for any corporate, but we allow them to run large NBFCs. We allow them to run large mutual funds. They hold public money as trust money. They do, they've been allowed to give given license for payment banks, for small finance banks. But only thing is on this, prior to 69, all these banks were owned by corporates anyway. So 69 was not a major crisis. It was Indira Gandhi's, so. As I said, we are not in 69. So this is a debate which is not going to end today, but I think we all agree at least that the risk capital is required. And if it comes from RBI, either way, either you do my loan against shares or you raid the balance sheet of the RBI, whichever way. But I think that clearly is a step. And about regulatory capacity, I think, first of all, the India Central Bank is a medley of everything, right? So if there's a way to separate supervision from the other aspects, then maybe that's one way to go forward. That we really need to focus on supervision. Therefore, capacity in its broadest sense about domain knowledge and all that. I think that can also be a step. These three steps can be taken.
There was an idea of creating a separate supervisory cadre at RBI.
Yeah. In fact, they've taken some steps already. They've combined the NBFC and the non-bank and bank supervision is combined, and now they've got an RM approach. By the way, I completely endorse what Rajiv said. My banking experience is more limited than his, but I've seen sort of live action supervision going on. They work very hard, and now there's an RM approach. What they do is, if it's a large entity to be supervised, they have a relationship manager for that entire group. So things are changing, maybe not fast enough. But so that's the way to go.
Yeah. So Rajiv, last question, and I'll begin with you and then go to everybody else. So I want you to do a little bit of a crystal ball grazing. And in 2025, 5 years on, we have a $5 trillion GDP dream. But my question is limited to banking. What kind of banking sector do you see? Do you see we are going to become a stronger banking system? We are going to become much weaker, or we are going to just bumble along as we are right now, we seem to be right now?
And the answer to that is quite simple, Harsh. I think it's your third option. We are the bumblebee of the emerging markets.
So we're going to bumble along.
But it's actually a very serious question you're asking, because it goes to the core of how optimistic or pessimistic we are about the future of our country. And as you are seeing, from the public discourse, all the noise around the farm regulation bill, etc., that it's a very curious situation. We are so the big challenge of the next generation reforms, in some sense, is to we are not able to make the pivot to a properly run private market economy because of the nature of our politics. So you're seeing what's happening in the Punjab. I mean, Punjab farmers have become accustomed to one reality, and they are unwilling to let go of that in the interest of the broader public good. You can't blame them for it. That's the nature, but that's the nature of our political system. In the case of banks, to translate that challenge in the case of banks, I don't know how much you follow social media, but it's quite interesting to find so many bloggers and vloggers on social media who actively represent and advocate that government should actually stand guarantee behind all depositors, right? So the small depositors in India, I mean, almost psychologically, the flight to quality is to public sector banking or public sector banks.
Rajiv, if I may, do you know the Nationalization Act has one line which actually does that? It creates unlimited liability for the government. It says the central government will ensure that no liability against this bank will stand. That's exactly the line. So there is a history to this. There is a basis for this expectation.
No, absolutely. That's my point. So so to make the transition, everybody's talking about privatizing the banks and so on. I'm just trying to point to you, it's not just a problem with DFS and Ministry of Finance and all of that. It's deeply embedded in our social fabric, this dependence on a dysfunctional state.
No, but that is, Rajiv, to go back to your point you made, on the one hand, the state seems to be shrinking, it's withdrawing, yes, but it hasn't figured out a way of getting private enterprise in. So we seem to be caught in the middle, because we can't have a transparent, trustworthy process of getting private enterprise where earlier state was trying to deliver. It happens in healthcare, it happens in education. So either we have a lot of backdoor privatization, unregulated, completely rampant, or completely failed delivery.
Actually, so if you'll allow me, just my summary of the problem is that we are not able to transition from the type of state we were in the 1970s and 80s to a well-functioning regulatory state, because we haven't been able to build the capacity and trust that a well-functioning regulatory state requires. And that journey is a difficult one.
It's a difficult journey. Jahangir, to you. Indian banking 2025.
I think your 47%. I think your 47% of GDP will probably go down to 45% of GDP. I don't think, as just Rajiv said, I think they're going to stumble through. Nothing really is going to shock the system, simply because in the next 5 years' time, I don't believe that this massive amount of global liquidity will be withdrawn. Things will change.
What would be the macro implications of this? The GDP, I mean, the macro variable impact of this.
Right. So, and India grows probably much lower than what we are used to, because of the global economy is also, going to be slower. But I think that most of the intermediation goes outside of the banks. Now, the question is, do the banks involve themselves in that intermediation through the investment books, or through the loan book. And my guess is that increasingly you'll find banks involve themselves in the intermediation of balance sheet, not of balance sheet, but through the investment books rather than through the loan books. And I think it is going to be it's going to show up as non-banks, increasing the intermediation, participating more. This is, by the way, almost identical to what happened in China. So if you look at China,
if I may interrupt, Anjali Sharma and I, we recently wrote an article showing that the bank's credit through bonds has risen from 4% of their total credit till 2010 to 8%. It has doubled in the last 3 years.
Exactly. And that trend is going to continue. We are now going to move away from government bonds to more corporate bonds. And I think that is the nature, and that is the way in which. And by the way, I'm just repeating what happened in China over the last 5 years. That's essentially
those banks are subscribing to bonds of large corporate NBFCs.
Yes, I know, but I'm saying
that's exactly
the rise is. But it has in 3 years it has gone from 4% of total bank credit to 8%, which is a very sharp rise, doubling in 4 years.
And that goes to the heart of the risk appetite argument that we were making. It is far less riskier for the banks to have on its books the same corporate exposure on the investment side rather than on the loan side.
This is an old problem. A branch manager cannot give a 50 lakh rupee loan, but can sanction a 10 crore bond.
That's exactly right. Exactly. And I think so. That's what's going to happen.
Yeah, Josh, to you.
I agree with the others that the most likely scenario is 5 years is a very short period of time. I think things will just bumble along for 5 years, except in one case. I feel if on the off chance, which I really don't think is going to happen, that industrial houses are allowed to own banks, I think we could see a very, very different scenario. Probably what will happen is in the beginning there'll be a huge burst in credit as these banks loan money to the related industrial houses, and that will have an initial very positive impact on investment and growth. But then of course it'll all go badly. And here I want to relate the story of Indonesia. In Indonesia, corporate houses were allowed to own banks in 1988. And by 1992, you had the first huge bank failure, Bank Suma, which collapsed with $700 million. Imagine at that time, 1992 we're talking about, 700 million in NPAs. And by 1998, 200 banks had failed, the entire banking system failed, and it required 40% of GDP to clean up the mess. Now, what one could say, one could say that, well, the RBI won't let that happen. But then I go back to the problems that I mentioned earlier, which is, and here I want to quote Rajiv Lal. He said, "You wouldn't believe the things that were going on right under the nose of the regulator." And unless this problem is solved, and I really don't believe that it can be. I don't believe that it would ever be possible to build up the supervisory capabilities to the extent that you could deter this. One of the problems is that it's absolutely impossible to define in a clear way what a connected loan is. If you have A and C who are related to each other, all you need is for A to loan to B, B to loan to C, and you have a connected loan that evades the regulations. So this is a very, very difficult problem to handle. No country has ever been able to handle it successfully, and I really worry what would happen if India went down this path. Plus, as I said, the fundamental issue is it's really not clear that this is the problem.
George, I have to stop you. Ajay has raised hand. Ajay, in the interest of time, can you ask your question, please? I just want to make sure we get all the audience questions in. Also, others, if anybody has a question, please raise your hands.
Yeah, I want to say three things. First, that some years ago, it felt like there was a moment when you could actually do the resolution corporation of the FSLRC. And it seems to me that that's much harder today because of the sort of stuff that was said a moment ago, that somehow there is now a great deal of a demand for unlimited sovereign guarantee on banking. And that's, in my opinion, one of the most dangerous developments, that we lost that moment when we could have done the resolution corporation immediately after FSLRC. It seems very costly to have lost that opportunity. I am not able to envision how to make banking regulation work, even in an ideal world of high policy capacity, while underwriting the balance sheet of all banks using the sovereign. So it seems to me one important thing has changed. My second point is that Jahangir started talking about global GDP growth after 2012, and I agree. Banking is a highly leveraged industry. In India, the average crude leverage ratio of banks is 20:1. There is way more leverage in banking than in derivatives trading. So basically, it's a punt on the underlying asset. When the economy does well, banking does well. When the economy does badly, banking does badly. And sluggish nominal GDP growth has made a huge difference. It has also uncovered bad news inside banking. As long as nominal GDP growth was high, the leveraged punt on GDP, that was banking, felt okay. For years and years, you had bad banking regulation and bad assets, and it was covered up. In an environment of low nominal GDP growth, it's just not possible to play that game anymore. So there is a deeper problem that we need to think about, because the world is now in a sustained low GDP growth environment. And my third and last idea is, okay, very well, we should think deeply about the environment where none of this stuff works, where there are no real policy responses, which is a scenario that is worth analyzing. I have often argued that there is a point at which so many plane crashes happen that you've got to wonder whether a country is better off without commercial airlines. It takes a certain minimum level of state capacity to feel that you should have commercial airlines. So in similar fashion, my mood is that India is better served with a small banking system, and that has adverse consequences. For example, what all of us are seeing in the last 5 years, the growth of the large firms at the expense of the middle and small firms. This is related to the decline of banking as a viable source of capital for the class of firms that really rely on banking heavily. Whereas by the time you are a top 2000 company in India, you can merrily exit out to the securities markets. So I'm not at all saying that this is a nice thing. I'm saying it is important for us to understand that scenario, that if there's going to be an unlimited sovereign guarantee, banking regulation will not improve, you'll not get a resolution corporation. The best thing I would dream of is a low bank assets to GDP ratio, and that will exert a drag on growth because the small and middle firms require banking.
To the panelists, anybody has any final comment before we close the discussion?
Harsh, I just wanted to clarify one thing. I didn't want this panel discussion to paper over the actual nuance in the working group document. So the working group document of the RBI is not unambiguously advocating corporate ownership of banks.
I know that, yes.
There is one very important nuance which tries to address this question of the need for additional capital.
Correct.
And that's raising the long-term ownership threshold for the promoter from 15 to 26%. So that opens the door to financial investors to actually become qualified promoters of financial institutions and banks, and fill some of the capital.
Which is, by the way, also what Nayak Committee had recommended. I was a signatory to that report. So
right.
There also they put at 25%, but this was the idea that it
Correct.
is not just the corporate houses, but even financial institutional investors could become sizable owners of banks.
So I don't want the audience to just dismiss the IWG, the stupid idea of getting corporate ownership. Actually, that's a bit of a red herring. The most important
part is the sorry, most important part is the ownership thresholds.
Correct.
Yeah. Anybody else? Jahangir, Josh, Ajit, any final comments?
Look, I mean, I would just echo what Ajay said at the end, right? I mean, and I think Josh has raised a fundamental issue, which is that, at the end of the day, these are in some sense, financial engineering solutions to an actual real problem. And the actual real problem is that we have serious issues with how infrastructure, which is where we need long-term financing the most, how on earth that is going to get financed. And to Ajay's point, if by any miracle we get a 10% increase in global trade tomorrow, however that happens, India grows up, none of us will be sitting around and worrying about the banking system. But I think, but even then, Josh's problem will still remain, that we will get trade financing and other such things going that make us banks look good. But infrastructure, where we really need solutions to how to fund infrastructure, that remains a problem. It's not a new problem, it's an old problem, but still remains the problem that India needs to crack.
Josh, I thought you wanted to say something.
Yeah, I do. Aside from thanking Jahangir, I also want to second what Ajay said. There's an old saying: to take care of the bank, take care of the customer. And what that means is, as long as the MSMEs are seriously struggling, the banking system is going to seriously struggle. And if you look at what's gone on over the past 3 years, first, general slowdown of the economy, then you had demonetization, then you had GST, then you had the COVID lockdowns, which hurt the MSMEs the most, and they found it difficult to get funding to tide them over. The MSME sector, you can just see from the profit figures, they've really had it hard over the past decade, and they're in serious trouble. So aside from all the other things that I mentioned earlier, you really need to somehow find a way to revive the sector if you want to have a good future for the banking system.
Ajit, to you with the last word, if any.
Yeah, we are entering 2021 on some reasonably good optimistic winds, the stock market, the foreign exchange strong, the inflationary out. So I think the one problem we'll have to face is the day of reckoning, when the moratoriums and the restructuring in the KV Kama committee and all that. When we are beyond that, I think the big problem that will face us is banking. And that's going to be the central theme next year. But I remain optimistic because you never know. Somebody mentioned technology. There's stuff like maybe a different class of banks. There are now these branchless models. There's those sandbox things. There's the NUE coming up, new umbrella entity, which
umbrella
RBI
entity
is
for payments.
So there are some developments which perhaps we are not going to see banking assets jump up, but I think we will hopefully be able to GST based the Nilekani model. So hopefully it won't be total stumblebee. It'll be better because we have many other things sort of blowing favorably as we enter 2021.
Thank you so much, Ajit. It is a wonderful, optimistic note to end on. Otherwise, I was worried that we'll all talk about just things going down. So thank you very much to all panelists. It's been a wonderful discussion. I hope you have a good day, remaining day. Good night, wherever you are.
Thank you.
And this concludes our Emerging Market Finance Corpus. Have a good day, guys. Bye.
Thank you.
Bye, everyone.
Thank you.
Happy New Year.
Everyone. Happy New Year. Yeah. Thank you.